Hi, I'm Ross from Smith Property Accountants in Hamilton. Today I'm looking at signs that you need a property accountant. Thought I'd give you a few examples and a few things to think about. So first, just a quick disclaimer, this is general information, not specific advice for you, and that you should seek professional advice if you need to. So do you wonder whether you're getting the best property accounting advice? So the first thing that I see so often is no chattels valuation. A chattels valuation costs about $400 or $500 through Valuate. And yeah, we've done a few examples before, and I'll show them again. We've got a client who had 3 properties. They weren't new properties, and they saved about $26,000 in tax through getting chattels valuations done. So obviously they had to get 3 at that cost. So even if we said 3 at $500, that's $1,500. To save $26,000 in tax is just amazing. It's the best return you'll ever get. Another client, it was a brand new property, they saved about $10,000 in tax through chattels valuation. And the last example was a really simple commercial property, not a lot of internal fit out. They still managed to save $17,000 in tax through getting a chattels valuation done. So number one thing in property investment to me is get a chattels valuation done, and make sure you can consider it. If you've got a newer property, it'll make sense. If you've got an older property, it might not, but have a chat to value it and it might actually be worthwhile. Other funny things we had just yesterday is another set of accounts done by another accountant actually had all the depreciation rates wrong. Small little thing, but if you're ever getting audited by IRD, you want to get the basics right. And generally, if IRD start to pick up problems, then they'll look harder and harder and harder. Another thing that we've had is a few years ago now is depreciating things that are not depreciable. Internal walls are not depreciable. Electrical is not depreciable, and internal plumbing is not depreciable either. So make sure you know what is actually a chattel, what can be depreciated. Otherwise, you're just going to get in trouble with IRD later. My next favourite thing is large personal house debt, and you've got a large current account. So what we're looking at is, can we legitimately move the debt from your personal home onto the rental properties, so then we can claim it for tax and save you tax. Often this can be relatively easy. It's called a restructure, and often we can borrow the money legitimately in a company or trust and then get a tax deduction for it. So we've got an example of a client probably about 6 or 7 months ago. They were buying a new holiday home. They had no cash to put in it, but they had these huge current accounts within their rentals. Over years, they'd put in about $600,000 into their rentals, paid the debt down a lot. So what we did effectively is we borrowed the money back again within the companies, we paid their current account, and then we could buy the holiday home debt-free, and that saved about $9,000 in tax each year, which is a huge saving. A partnership with large losses that could go to a high income earner. So this is an example. We've got a rental partnership that's losing $23,000 a year. We've got John, who earns a high income, $180,000 a year, and he's taxed at 33%. Then we've got Jane, his wife, who's part-time. She's only earning $8,000 a year. She's only taxed at 10.5%, and her total tax paid is only $840. So the key thing with that is, if she is getting a loss, she can only get the $840 back. You can't get any more. So the partnership structure at the moment is tax refund is about $4,600, basically getting a portion of the $23,000 loss back and offsetting John's tax and getting tax back, plus getting the $840 back for Jane. It would be possible to restructure this, or it could be possible to restructure this. If we could structure it another way, it would be possible to get a tax refund of about $7,500. So a huge amount extra, about $3,000 extra per year. So it's worth looking at that. Interest not claimed during the build. This is an example where many accountants just don't know the rules. They deal with businesses, they deal with farming, they deal with auditing, they don't concentrate on property. So while you're building a new investment property, you could easily spend $15,000 on interest. Therefore, you should be able to save about $5,000 in tax, or get that offsetting your income or if you're profitable, not paying that amount of tax. Repairs claimed at a cost of a building. It's the obvious thing for IRD to look at is to audit repairs. It's their number one risk area. So here's another example. Tom just purchased a long-term rental in September 2016. Straight away, he does renovations costing $25,000. He might be painting it, he might do a new kitchen, a new bathroom, general things that might normally be a repair, but because he's done it straight away, it's the cost of buying it. So these are not deductible at all because it's the cost of buying the property and capitalised. It's amazing how many investors and how many accountants get this wrong, and yeah, it's really just waiting for IRD to audit them, and obviously high repairs stand out in a tax return, so they're likely to get audited at some time, and then you're looking at high penalties and interest from IRD. The other part is there's probably chattels, so if you put in a new kitchen, there's likely to be a new stove, a new range hood, a new dishwasher. Those are all chattels that you'd both to break out and depreciate, so it's important that you take out as much as you can of that example and depreciate it, but actually a lot of those core renovations will not be deductible. The other option is you could wait for a few years and then do them later, but generally it's better to do the renovation straight away, get a better tenant, get better rent, and unfortunately not the tax deduction. So generally we aim to get the losses to the higher income earner. If there's a profit, get it to the lower income earner. All the debt on the rental properties and ideally nothing on your personal house. And maximise deductions legitimately. We don't want to claim things that you're not entitled to and just get in trouble with IRD. That's not good for you and it's not good for us either. So yeah, if you think you're not getting the best accounting advice around property at the moment, you send an email through to Maurice and we can organise a chat for 5 or 10 minutes, where I can have a chat to you and work out how we can help and how we can help you get ahead with property investment. Thank you.